Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Generac Holdings is the dominant residential standby generator brand in the United States, holding roughly 75% market share. Headquartered in Waukesha, Wisconsin, it was founded in 1959 and went public in 2010.
A residential standby generator is a permanently installed unit that automatically activates when grid power fails. Unlike portable models, standby units run on natural gas or propane, powering an entire home indefinitely without refueling.
The residential segment generates about $2.5 billion annually. Commercial and industrial generators add roughly $1.5 billion from data centers, healthcare, and telecom. Energy technology rounds out the portfolio.
The brand moat is decades deep. Generac's name is essentially synonymous with home standby power in the U.S., a position reinforced by a national dealer network, technician training programs, and service relationships that competitors cannot easily replicate.
The installed base compounds quietly. Every generator sold creates a long-term service relationship, maintenance contracts, replacement parts, and eventual upgrades. That recurring revenue grows independently of new unit demand cycles.
Demand is event-driven. Hurricanes, ice storms, and wildfires trigger awareness surges that drive multi-quarter order spikes. The 2021 Texas winter storm Uri was a defining example, triggering extraordinary demand across the U.S. residential generator market.
That event-driven cycle creates volatility. After the 2021 surge, residential orders normalized in 2023 as dealer inventories cleared. Generac reduced production and defended margins through the correction, a managed transition rather than a crisis.
CEO Aaron Jagdfeld has run the company since 2008. His strategic vision extends beyond generators into home energy storage and grid services, areas where Generac's dealer network and homeowner relationships provide a credible entry point.
The PWR cell battery platform reflects this evolution. As rooftop solar adoption grows, homeowners want storage for backup power and energy management. Generac's installed base and installer network give it a realistic path to capture share in that market.
Grid services is another initiative. Generac's connected generator fleet can be aggregated into a virtual power plant, providing demand response to utilities and generating recurring revenue from assets already in customers' homes.
Gross margins run around 35%, with operating margins recovering toward 12%. The balance sheet carries some debt from acquisitions, but free cash flow generation supports continued deleveraging and investment in the energy technology build-out.
The competitive landscape in residential standby is benign. Cummins and Kohler compete more heavily in commercial and industrial. No competitor has threatened Generac's residential dealer network dominance in any meaningful way.
Long-term demand is supported by grid reliability concerns, more frequent extreme weather, and the rising cost of power outages as homes become more electrified with EVs, medical devices, and connected systems.
Generac does not pay a dividend. Capital is directed toward R&D, energy technology investments, and debt reduction from the 2021 expansion.
That's the company chapter for Generac Holdings. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Generac just dropped a quarter that finally rewards the patient holders. Q1 2026, revenue up 8.4% year-over-year to $1.015 billion. EPS came in at 118 versus the street's 104 estimate, a 13.5% beat. Residential generators rebounded, data center backup power scaled, and the stock caught a bid. This is Charged Alpha. Let's break it down.
Generac Holdings is the dominant name in backup power. They make home standby generators that kick on automatically when the grid fails, portable generators for job sites and emergency use, and a growing line of energy technology products, home batteries, solar plus storage systems, and grid services platforms. Market cap sits at roughly $12.2 billion. The brand is so synonymous with the category that people genuinely say Generac the way they say Kleenex.
But the real growth story has shifted. Residential is the cash cow, but the commercial and industrial segment, particularly data center backup power, is where the multiple expansion is coming from. Hyperscalers are building at unprecedented rates. Every facility needs redundant generator backup, and Generac is one of a small number of suppliers with the scale to win those orders. That exposure is why Generac trades like a power infrastructure name now.
Let's walk the income statement. Total revenue was $1.015 billion, up 8.4% from $937 million in Q1 2025. Gross margin came in at 38.3%. Operating margin was 6.9%, and net margin 3.8%. EPS of $1.18 beat the consensus of $1.04, a 13.5% surprise driven by better residential mix and stronger C&I volumes than modeled.
Segment-wise, residential generators came back. After 2 years of destocking, the channel cleared, and major storm activity, the LA fires earlier this year and the active hurricane season last fall, drove home standby installation demand higher. Commercial and industrial grew faster than residential, with data center backup power the standout vertical. Energy technology is still margin dilutive, but the loss is narrowing quarter over quarter.
On cash flow, trailing 12-month free cash flow stands at $357 million, and operating cash flow was $189 million for the quarter. The company ended Q1 with $341 million in cash against $1.333 billion in total debt, net debt of $992 million. Total equity is $2.633 billion. Leverage is manageable, and management has prioritized debt paydown over aggressive buybacks at this valuation.
Capital allocation has been disciplined. Generac is not a buyback-heavy story. Cash flow is going toward debt reduction, capacity expansion for the C&I plants, and bolt-on acquisitions in energy technology. There is no dividend. For a high-beta industrial with a multi-year capacity build-out ahead, reinvesting in the business is the right call.
Return on equity is 14.6%, and return on assets is 5.8%. Solid for an industrial of this size, but below where Generac printed during the pandemic-era boom when ROE crested above 30%. Investors are paying for durable mid-teens ROE with data center growth on top, not a return to supercycle levels.
One number frames the whole quarter, the 38.3% gross margin. That is roughly 200 basis points better than the trough quarters of 2023 when inventory was cleared at discount. Margin recovery plus volume growth is the operating leverage formula, and Q1 finally delivered both. That combination triggered the EPS beat.
Analyst coverage is firmly bullish. The consensus breakdown is 10 buy ratings, 5 holds, and 0 sells. No analyst on the street has a sell rating on this name. The average price target across that group is $215. With the stock trading at approximately $207, Generac is sitting roughly 4% below the consensus target. That is a much tighter risk-reward setup than most coverage names, modest implied upside, but no analyst calling for downside.
The valuation math. Generac trades at roughly 25 times trailing earnings and about 19.9 times forward estimates. EV to EBITDA is 14.8 times. Price to sales is 2.89 times. By industrial standards, this is a premium multiple, but the bulls argue it is justified by the data center exposure. Power infrastructure names with hyperscaler customers consistently trade at higher multiples than legacy industrials.
The bull thesis on the street centers on 3 numbers: forward revenue of $5.4 billion for fiscal 2026, forward EPS of $10.42, and a data center backup power total addressable market that bulls peg at well into the tens of billions over the next decade. If Generac captures even a mid-single-digit share of new data center backup demand, the C&I segment alone justifies the current multiple.
The holds, 5 of them, are not negative. They simply argue the data center thesis is largely priced in and that residential demand remains weather-dependent and therefore lumpy. Their case is that the stock can grind higher with earnings, but multi-bagger upside requires a fresh catalyst, likely a major hyperscaler contract announcement or a structural step-up in storm-driven residential demand.
Beta of 1.79 is the elephant in the room. Generac moves nearly twice the broader market in either direction. In a risk-on environment with industrial multiples expanding, that is a feature. In a drawdown, the same beta means painful swings. Sizing matters more here than for a low beta defensive industrial.
The bull case has three pillars. First, data center backup power. Every new hyperscaler facility requires multi-megawatt diesel or natural gas generator banks for grid failure redundancy. Generac's C&I product line is purpose-built for that demand, and order books are being booked years out. Pricing power is real because qualified suppliers are few.
Second, the storm cycle. Climate volatility is driving longer hurricane seasons, more wildfires, and more frequent grid events. Each major event triggers a measurable spike in home standby installation inquiries and orders. Generac's installer network, over 10,000 certified dealers, converts those inquiries faster than any competitor. The residential business is leveraged to a structural increase in extreme weather frequency.
Third, energy technology optionality. The home battery and solar plus storage business is currently a drag on margins, but the long-term TAM is enormous if utilities continue rate hikes and grid reliability deteriorates. Even modest profitability in energy tech would meaningfully re-rate the consolidated multiple. That is free upside in the current numbers.
The bear case starts with residential cyclicality. Home standby generators are big-ticket discretionary purchases, $5,000 to $15,000 installed. In a recession, in a housing slowdown, or simply during a quiet storm season, residential demand can drop sharply. The post-pandemic destocking cycle that ran through 2023 and 2024 is still fresh in memory, and another inventory correction is not impossible.
Second, execution risk on the C&I scale-up. Building data center generator capacity requires plant expansion, supply chain depth, and skilled labor. If Generac stumbles on any of those, missed delivery dates, quality issues at scale, component shortages, hyperscaler customers have other qualified suppliers, and they will switch. The data center revenue line is high stakes.
Third, the high beta of 1.79 cuts both ways. In a market correction, Generac can give back 20 to 30% in weeks, even if fundamentals are unchanged. That volatility is uncomfortable for retirement account investors and is a real reason some institutional managers cap position sizes well below where the fundamentals would otherwise justify.
Fourth, valuation is stretched if data center growth slows. At 19.9 times forward earnings, Generac is priced as a premium industrial. If hyperscaler capex moderates, which has happened in prior cloud cycles, the multiple compresses back to the teens. There is no margin of safety in the current price.
Generac's listed peer group includes Chart Industries, Edgewell, and SunPower for the storage angle. But the more relevant operational peers are the engine giants, Caterpillar and Cummins, both with substantial backup power businesses competing directly with Generac in the C&I and data center verticals.
Versus Caterpillar, Generac is a pure play. Cat is a sprawling conglomerate where backup power is a small slice of revenue. Cat trades at a lower multiple, but Generac captures more direct upside from data center backup demand. If you believe the thesis, Generac gives concentrated exposure that Cat dilutes.
Versus Cummins, the comparison is closer. Cummins has a major power systems segment competing head-to-head with Generac's C&I line. Cummins trades at roughly 15 times forward earnings, meaningfully cheaper. The premium Generac commands reflects faster residential cross-sell and energy technology optionality Cummins lacks at scale.
On the residential and storage side, Generac is essentially uncontested at this scale. Tesla's Powerwall competes in home batteries but does not sell into the standby generator channel. SunPower is in restructuring. No other U.S.-listed company has the dealer network and product breadth to challenge Generac on whole home power right now.
Options activity heading into the print was tilted bullish. The put-to-call ratio sat at 0.78, meaningfully below the 1.0 neutral line. That skew suggests positioning was leaning toward an upside surprise, and the 13.5% EPS beat validated those buyers. Implied volatility was elevated given the 1.79 beta. Earnings move pricing was wider than average for an industrial of this size.
Looking at longer-dated options, January 2027 calls show open interest concentrated at the 225 and 250 strikes, suggesting institutional positioning for continued data center narrative expansion through the year. Put activity at 180 represents downside hedging from holders who want to keep the position, but are aware that any data center capex slowdown would hit this name disproportionately.
On insider activity, there has been no material insider buying in Q1. Routine 10b5-1 sales by executives have continued at standard cadence. Those are pre-scheduled and not informational. Importantly, there is also no clustered insider selling that would signal concern about forward demand. The pattern is neutral, which for an industrial reporting a clean beat is a constructive read.
Institutional ownership is high, over 90% of the float. Vanguard and BlackRock are the largest passive holders. Active managers have been increasing positions over the last 2 quarters as the data center narrative gained traction. Short interest is modest, suggesting even the bears are not aggressively betting against the name.
Bottom line on Generac, residential is recovering, data center backup is scaling, the EPS beat was real. The fundamental case is intact. The risk is the beta. At 1.79, this stock will not let you sleep through a market correction. Position size accordingly.
If you own it, the data center thesis is the load-bearing wall. Watch hyperscaler capex commentary. New buyers should respect the volatility and scale in. Charged Alpha rates this a constructive buy with discipline. Real growth, fair price, high beta sizing.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.